Of course, that's Jim Bianco, but I will introduce him in a second. Before we get going, a couple housekeeping matters. Thank you guys so much for joining us. I appreciate that it's live, and I appreciate all the messages you guys send and the DMs. Your support has been amazing. To our sponsors, first, we always complain about big conglomerates taking over the food supply. There is something we can do. That's to patronize Marco at Independence Arc. Grass-fed, grass-finished beef. You will love it. It's amazing, and he's a great guy to deal with. The American Gold Exchange. I've been advocating owning physical gold and silver, and yeah, I know there's some problems that come with that as far as storage and guard dogs and guns, but it's worth it. Work it out. American Gold Exchange, Dana Samuelson. And lastly, unfilteredinvestor.com, which is mostly Mike Arnold and Bob Iacchino, and I'm there for the laughs, but so far we've been getting good traction, and their research is amazing. Jim Bianco of Bianco Research, how are you? And do you spend all winter in the sun now? I know you're somewhere warm right now. Are you planning on spending a long time there?
Yes, I'm in Scottsdale. I'm going to be here for at least a month, and then I'm going to go back to Chicago for 2 weeks, and then I'm going to go to California for 2 months.
Fantastic. That is so awesome. I had planned on spending, winters in the Keys, and last year we spent like 3.5 weeks, and then this year I took a gig coaching high school basketball, which happens to be in the winter around here. So until the season ends, I'm stuck in the goddamn cold. But anyway, Bobby, what do you got?
I wanted to ask you, Jim, last week at Twitter, it's what sparked me to make sure that I could book you for this particular day. You talked about some of the things that were going on with Brandon Johnson in Chicago and the fiscal situation. I don't really want to give you too much of a lead in on that. And I know, again, that's pretty niche. Like all three of us are from Chicago. I live in Florida now. Jim, you still live there. Jim, you still live there full time. I asked you in there why you still live there. I know Iorio still lives there, but I don't know why Bianco still lives there. But talk about that a little bit as to what you saw and what you were commenting on.
Yeah, and I don't know why I still live there either.
Family and stuff. Yeah.
So a couple of things. Chicago has, been in the news a lot because of crime, because of its finances. It's been having problems with its finances. And there's two things. What sparked it was there was a big bond offering that Chicago had. And the offering didn't go that well, but it went well enough that they got the deal done, but they had to raise the price. And it begged the question, why does anybody buy Chicago bonds? Because they're the lowest rated bonds in in basically of all the big municipalities. As a matter of fact, Bobby, I gave you this trivia question, right? Yep. Who is the biggest junk bond issuer in the world? And the answer is the Chicago Public School System, because they issued $9 billion worth of below investment grade bonds. No one else has issued that many below investment grade bonds.
So hold it, quick timeout. Are you asking the question rhetorically of why people would lend them money? Because I have a 2-second answer. Implicit federal backing. Now you go. I didn't mean to take anything away. Yeah.
Yes. But the answer is you're right, but take that one step higher. Implicit state backing, because the state of Illinois' Constitution does not allow for Chapter 9 municipal bankruptcy. And that means the Chicago or the public school system or the fire department or anything else cannot go bankrupt. Now, that's a problem. Why is that a problem? Because they can't go bankrupt. Because normally if a state or a city, actually it's Chapter 9 is only for cities and municipalities, but if a city can go bankrupt, you could turn to your pensioners, you could turn to your employees and say, look, you got to accept X. And if you don't, we're going to go bankrupt. We're going to file for bankruptcy and you're going to get worse. But when it comes to Chicago and you turn to them, and you turn to the pensioners and you say, you got to accept X less, they say, no, we don't. We don't. And this conversation's over. And that's where the biggest problem comes in with Chicago. 40% of the budget of Chicago goes to one of three things: pension payments, healthcare benefits for pensioners, and interest on debt. So that means that 40% of the taxes that Chicagoans pay go to pay for previous services, not current services in the city of Chicago. And that's where its finances are all messed up. And because of this lack of Chapter 9 of the bankruptcy, there's not a whole lot we can do about it.
Where does it end?
Well, I'll tell you, I'll give you an alarming statistic. Where it ends is that Chicago keeps paying into these pension systems and for retiree healthcare benefits, and it pays its interest debts. And it's largely meeting that, but it's taking away from current city services. So I'll give you two scary statistics. In 2019, 19% of priority 911 calls went unanswered in the city of Chicago, 2019. Today it's 50%, because they have to divert more and more of the resources to pay pensions and to pay interest on the debt and everything else. The other statistic I would give you is unsolved murders. Chicago only solves about 20 to 25% of its murders, whereas a city like New York City or Los Angeles are around 55 to 60%. They just don't have the resources to solve murders. So where it ends is they continue to pay these pensions, they continue to pay healthcare benefits, they continue to pay interest on debt by taking away current services more and more and more. It ends when the public says, enough, we're done with it. You're not taking anything else away from us. Change the Constitution of the state of Illinois to allow to restructure these benefits so that we can get we can get our 911 calls answered, we can get our murders solved, we can get our streets plowed, we can get our garbage picked up and everything else, because that's where it's going right now.
So what I think, and tell me if you think this is a good thesis, then Bobby, you can ask your follow-up too. I believe that in 10 years time, perhaps, that's just an arbitrary amount. I believe, particularly if the Bears move out to the suburbs, right now there's 10 million people living in the suburbs of Chicago and 2 million people living in the city proper. In 10 years, there is a chance that the city of Chicago is viewed as like a museum tourist part, like some of the city in Europe's, whereas the suburbs of Chicago are viewed as the commercial center. Do you think that's possible, reasonable, or do you think Pritzker is going to come after our money just the same to float Chicago?
Well, I think you're right, and there's a couple of examples of that in the Midwest. If you look at Detroit and if you look at St. Louis, that's essentially what those cities have become, that the city center has been hollowed out except for a couple of business districts and entertainment districts. In Chicago, that would be basically the whole north side of Chicago. And everybody else lives in the suburbs, and the rest of the neighborhoods are either empty. In the case of Detroit, they've just emptied it out. There's just full city blocks that are empty. Or in the case of St. Louis, it's just too crime-ridden that anybody wants to live there. Now, the problem, of course, is whether or not the state comes in. The state has to come in and meet those benefits. The only way we can change anything in Chicago is we have to change the Constitution. So if everybody empties and leaves the city, and by the way, let me back up a second. Why is Chicago in this pension problem? In 1970 was the last time they changed their constitution. The population of the city proper was 3.6 million people. Today, the population of the city proper is 2.3. You've lost 1.3 million people that lived in Chicago 55 years ago from today. Who leaves? Those who can. Who's those who can? Those that pay taxes. Who stays? Those that can't. Those are usually people that require city services. And so that's why you're in this predicament, is that it made sense in 1970, but what they didn't anticipate was what happens if a third of the tax base leaves the city. And that's essentially what they've done. Now, a lot of them have gone to the suburbs, or they've gone to Northwest Indiana. And so this is just going to continue to get worse and worse for Chicago until something forces a change. And the change has to be at the state level. And the state level, and what I would actually have to guess would be what you said, Jim. At some point, we're going to have to realize Chicago can't go bankrupt. The state is backstopping Chicago. The state needs money to backstop Chicago. There's already a bill that's not a bill, but a proposal in Springfield, which is the state's capital, to impose a surcharge on real estate taxes in the suburbs around Chicago. So everybody who lives in the suburbs, you might say, look, there's going to be a $5,000 surcharge on your real estate taxes to pay for Chicago, because the state has to pay for it. Chicago can't go bankrupt. If Chicago stops paying, the state pays. It's just that simple. That's
Bobby, I want you to take the next question, but I just want to say how absolutely ridiculous that is. And I know that it's coming, and it just makes me crazy. Bobby?
Well, the thing is, like, both of you live outside of the city. Am I correct in saying that, Jim?
No, I live in the city.
He lives in the city, yeah.
Jim lives in the city. I lived in the city for most of my adult life, childhood, then suburbs, then back to the city when I was 23. So my adult life was spent in the city of Chicago, say for 4.5 years in Los Angeles, 6 months in New York, and then I moved down here about coming up on 5 years ago. What I saw in Chicago was the easy parts about living in the city disappearing. The corner taverns, being able to walk to restaurants safely, whether it be at night or anything like that. Having to take an Uber in my old neighborhood 4 or 5 blocks home because I didn't know what I was going to encounter on the way back. What is, Jim, that was a question, Bianco, that was a question I wanted you to answer. The question I wanted to answer, you answered it, is to why it can't just abandon Chicago. And you said it's in the Constitution, basically, if I understood you correctly.
Right. Yeah,
the state constitution, and they will start levying taxes on the suburbs. My opinion is they would hit the businesses first that are in the suburbs, but then they can leave easier usually than the people because they don't care about their mom living 5 minutes away or their cousin living down the street. But my question is, what is the attraction of places like Chicago, Detroit? I think the same thing is kind of happening in Cleveland a little bit, where like these cities, you used to build cities around ports, around water, right? We don't need to do that anymore. Why can't it fail? Why can't they just let it go?
You're exactly right. I mean, Chicago has been, the reason that Chicago is where it is it was the crossroads of the country, right? All the railroads intersect in Chicago. We had, you know, the Chicago River that feeds into the Great Lakes to the Mississippi. All commerce flowed through Chicago. And that's why Chicago was geographically positioned to, at one point, be the second largest city in the country. Never surpassed New York, but now it's the third largest city in the country after Los Angeles, and soon to be the fourth largest city, because I think Houston's very close to potentially overtaking it. What the northern climates would have to offer, it's all backwards, right? Why would people want to stay in Chicago? Because they had a good business environment. If it was remember, we used to call it the city that works many years ago. And it was because it had a friendly business environment. It was a good place to put your business. Yeah, you froze your ass off in the winter, but everything else was very accommodative to be in Chicago. Well, it's losing all of those things right now. As a matter of fact, what's also happening in Chicago is there's a reassessment of all real estate taxes. And this, not to get into the weeds, I'll make it simple. The Loop, the central business district, is got such high vacancy rates, and the property values in the Loop have fallen so much that they got breaks on their real estate. So somebody's got to make up the difference, and they can't make up the difference on the rich north side because they've already taxed them to full value. So it's every other neighborhood in the city. They've been raising rates, like in the Lawndale neighborhoods and stuff like that. That's in the southwest side of the city. Real estate taxes are going up 100%, and there's like they're almost talking about an open revolt against paying their real estate taxes.
Right.
This is
I've heard
the
that
problem that the city has right now.
That's amazing. Let's
real quick, Jim. Our
go
friend
back.
Rich Kunkel, who watches the show all the time, posted on Twitter. Please tell Jim just to move to Florida, solves all his problems. I'm working on my own escape.
It doesn't solve my problems, Rich.
I think he's actually talking to Bianco.
Businesses.
Yeah, I think he was talking to me too. But
it might be talking to you, right? Yeah, you don't have a restaurant.
I'll say this in conclusion. I talk to all my neighborhoods, and I got to tell you, my neighbors are either they fall into one of three buckets. They're either actively moving out of the city, they're thinking about moving out of the city, or they're pissed off they still live in Chicago.
Yeah, no, I know.
It's basically the three people that live there right now.
What a terrible thing to be in.
Yeah,
it's amazing. Sterling or Haley, can you guys clip that part so that's portable? Because there's some people I'd like to send that to regarding Chicago and its state. Can we move on to federal, boys?
Yeah, please.
Yeah.
So I'm talk about gaslighting, for the love of God. When we see the Fed meet last week, was that Wednesday or Thursday, whatever it is, and Wednesday. They launch full on 40 billion of QE to buy treasuries, expand their balance sheet.
Management. It was called reserve management purchases.
But they say
RMP.
Right. It's not QE. I don't know what are you guys talking about? Of course it's not QE. So to me, as you know, Jim, because we've talked about this a long time, and I believe it was yours too, this has been my base case for 2 years, is that eventually they would have to come back in and start QE. That's the reason I've been long gold, long silver, long those things uncomfortably, and they're going through. By the way, there's a lot less satisfaction being right about a trade that's about the government's stupidity and incompetence regarding stewardship fiat currency. I'd love to have it be NVIDIA, but I've made a lot of money in gold and silver. Where does this take us now? What are your thoughts on this whole bullshit QE thing?
Well, you're right. I mean, let's talk about why they're doing this reserve management purchase of 45 billion. And the reason they call it not QE is because they're buying treasury bills, where they said that quantitative easing is when they bought notes and bonds, or to put it in bond
longer term. If you guys don't know what he's talking about, that longer term, the notes.
Yeah, they bought longer term securities, like 5-year, 10 years, all the way out to 30-year securities. The Fed would purchase those. But now they're buying treasury bills, 3 months, 6 months, up to 1 year. So that's the hat that the Fed's hanging on, that it's not QE, that we're not buying long-term bonds. By the way, just so everybody knows, how does the Fed buy these things? They usually call up a bank, and they say to the bank, I'm the Federal Reserve Open Market Desk. Sell me $1 billion of 5-year notes. Okay, fine. We sold you $1 billion of 5-year notes. How does the Fed pay for it? Well, the Fed says, you have a reserve account with us. Get my pencil out, erase that number, add 1 billion to it. There, I just paid for it. So they just invent the money to pay for it. Now, that's the way the Fed has always worked forever and ever. That's the way it's always worked. Now, in theory, what that does is that gives the bank more reserves. That allows the bank to expand its balance sheet, hand out more loans, buy more securities, and they can earn interest off of that. So it is of value to the bank that you change the number on my reserve account to a larger number. So they're doing that with bills now. And the last thing I think we should, before I talk about the meaning of it, why are they doing that? Well, for 3 years, since 2022, the Fed was doing quantitative tightening. What does that mean? The Fed had $9 trillion of treasury securities that they purchased through this, inventing the numbers on everybody's reserve account. So they wanted to reduce the size of those numbers, the size of that holding. How did they do it? Every month they had like about $150 to $200 billion worth of securities that matured. They would just buy back 90 billion less, then 50 billion less, then 30 billion less. So if they had 150 billion that matured, they would buy back 100, they would reinvest 100 of it and not 50. So their balance sheet would fall another 50 billion. They took their balance sheet from 9 trillion to 6 trillion. What happened as they were reducing their balance sheet? The funding markets, the repo market got tight. What is that? Well, we have a $38 trillion treasury market. And there's a market that they use to finance that market. That's the funding markets or the repo market. And so as the Fed was reducing their balance sheet, reserves in the banking system was coming down. And that was impairing the ability to fund the treasury market. Let me give you an example. I'm a hedge fund. I just bought $1 billion worth of 2-year notes at the recent auction, just to give you an example. Do I have $1 billion in some checking account? Because I got to pay the treasury for that $1 billion of treasuries I just bought. No, I don't have any money. What I have is I have $1 billion of treasury of 2-year notes. And I go to a bank and I say, here's collateral, $1 billion of 2-year notes. Give me $1 billion loan so I can pay the treasury. What these hedge funds and broker dealers and other players were finding was you'd go to Bank X and say, here's my $1 billion of 2-year notes, give me $1 billion loan. And the bank said, I'm out of capacity to hand out repo loans because my reserves have fallen too much. Call another bank. And so these hedge funds and these broker dealers and stuff would then bid on it, and those rates were going up. So the reason the Fed is doing these reserve purchases is they're trying to add reserves back into the banking system so that when you go to the bank and say, I have $1 billion of 2-year notes, give me a loan. Sure, no problem. Here we go. And you get the loan and we're done and everything's fine. What's the concern? And this is where I think this reserve market purchases and QE, they're the same thing.
Yeah.
The problem is not what you buy to finance, to expand the funding markets. It's what the funding markets are allowing. a $38 trillion treasury market that is growing by $2 trillion a year because the government is running a $2 trillion deficit. The Fed has just said to Congress, we all bitch and moan you guys are spending too much money and you've borrowed too much. Keep doing it. You don't ever have to change. Don't ever stop. Now, what is the biggest reason we have inflation other than the supply crunch after COVID? Government spending.
Hell yes. Yeah.
So you're telling the government, do more of it. And then we're going to turn in a year or two and go, Jesus, where'd all this inflation come from? And we don't have anything to do with it. That's what would have been a better answer is you should have turned to Congress and said, you know why these repo rates are going up? You know why these funding markets are getting tight? You guys borrow too much money. Yeah. And maybe you ought to think about backing off on the amount of money you're borrowing. But nope, we're just telling them to continue. So the next time Jay Powell goes out there and laments, Congress is borrowing too much money. It's the deficits are too big. You're the biggest damn enabler of the thing in the entire country through this reserve market purchases. Don't call it QE. It's all about government spending.
It is so maddening when you know a little bit about it. And by the way, I was on a show on Friday, the Looney Hour in Canada, which is actually an excellent finance podcast. And I just described it, the whole repo thing, as if you just look at the chart of repo of money that's in the repo facility, all that represents is money, less demand for short end treasuries as it goes down. That's the simple way to say it, right? Okay, right. So now onto the inflation thing, because here's where I actually disagree with you, which, by the way, it is never comfortable for me to disagree with you because it's happened about 10 times, and I think I've been wrong 9 of them. But anyway, so here's what I think, too. The inflation part
with me, and she's not wrong 9 times.
By the way, speaking of wives, if guys like us didn't have wives, we'd go through life thinking that we were smart. We need wives to convince us that we are not. I'd like to thank you, Peg. Thank you for all the knocking me down you do. She'll never listen to one of my podcasts too. Okay, the inflation component of it. I actually believe that this AI thing, whether it's real of what AI can provide to these companies versus what they think it can provide, either way, I think it's punching the labor market in the nards right now. And I think that companies aren't increasing headcount because they believe AI is going to increase productivity. So either they're right, and it does increase productivity, which is disinflationary, or they just break up the labor market for no reason, thinking it will, which is also disinflationary. Where am I wrong? Why do you think it's going to be inflationary just because of the monetarist viewpoint?
Yeah, well, there's two things. I talk with the AI thing, and then the other one is population growth. So you're right. I count me in the camp that thinks AI is as big a deal as the internet itself, if not a bigger deal. But also, I'm old enough to remember in 2018 to 2019, Elon Musk told me that by 2025, we wouldn't own cars anymore. We would have tens of millions of driverless taxis, and you'd push a button on your phone and a driverless taxi would show up in 15 seconds and take you wherever you wanted to go. And you'd save all that money by buying 2 cars and having a garage. Okay, it's 2025. That didn't happen. But at the same time, with Waymo and everything else, you can see where that might happen. But it's going to take a lot longer than everybody thought. But it's going to happen. AI is the same thing. I can absolutely see where we're going with this. And that's why I said I think it could be as big as the internet. But it may not be a 26, 27, or 28 story. It might be more of a 2030 to 2035 story. But it will happen. And the other thing I'd say about AI, as far as jobs go, a lot of businesses are trying to become more AI savvy, be open to AI. I don't know if they're actually at the point where they're delaying hiring, except for a couple of specific examples, like coding would be one example. It's very difficult to get a coding job right now because coders are so much more productive because of AI. And the reason is, real quick, what does a coder do most of the time? Here's 5,000 lines of code. It doesn't work. Go figure out why it doesn't work. And in line 2,338, somebody forgot to put a comma in it. And that's why it doesn't work. And it takes them who knows how long to figure that out. AI can figure that out in 10 seconds. That it's this line doesn't work. And you look at, oh yeah, put the comma in there and we're done. That's why they're so much more, they're so much more productive than they've ever been. But I do think, yeah, go ahead.
No, go ahead, Jim.
I was just going to say, I do believe that technology is a net creator of jobs. It always has been.
But not always in the short and medium term.
Right.
Right.
Because what it'll do is it will change business models. Business models that are currently not economic will become economic. And you're right, in the short and intermediate term, you might lose more jobs than you create in the long term. That's the challenge. I'll give you an example of a technology that came along and we didn't manage it properly, the Industrial Revolution. Everybody left the farms, they came to the cities to work in the Industrial Revolution. It created so much disruption that we got a pushback, and that pushback was called communism. And so now the pushback to AI won't be communism, but it'll be something similar to it, to say we need to slow down this advance because all we're doing is losing jobs, whereas these jobs we're supposed to be creating, they came slower over time. And so that's always the concern when you have a transformative technology, that you get that kind of a pushback.
So this is I just want to add into the AI thing. Then I want to actually go back to the Fed if we could for a quick second. The AI thing to me is obviously going to eliminate jobs, and then there'll be a transition. Some people believe it will create new jobs just like every other big advancement has. Or will this be the one that finally demands income from the government, and just nobody's working and they're all just playing violins and writing poetry and all that crap. From that perspective, though, this is obviously a small anecdote, but I was trying to figure out, I had to do a commentary today for one of my clients. And I had to talk about the earnings that were coming out today after the close. And one of them was AbbVie, right? It's a French company. It's a biotech company. And I, for the life of me, I'm looking at this word. I'm like, I don't know how to pronounce this word. So I spelled it in a chat GPT and it kept adding letters. Except it kept saying things like it's AbbVie, like there's one V. I'm sorry, you just say it like AbbVie. I'm like, there's one B. It's obviously a small story, right? It's a small little anecdote. AI is not perfect yet. And that's why I don't personally think it's going to have any stopping power for the next batch of inflation. 2 or 3 batches of inflation, maybe. But I don't think it's good enough yet to prevent another inflationary move higher if we keep QE. Does that make any sense to you guys?
It's fair. It sounds fair to me. And that's what Jim's saying, I think, right?
Yeah, exactly. It will come. You're right. It's not there yet. It's kind of like the Waymo taxis, right?
Yeah.
I still have 2 cars in my garage. You probably still have 2 cars in your garage, and you're probably going to buy a new car in the next couple of years anyway. But can you envision a day when we don't have cars? That the world is 30 million driverless taxis. Push a button on your phone and you don't have to wait more than 15 seconds, like I said. And
I can't wait. I'm going to drink my ass off when that happens.
Me too.
Yeah, exactly. You could see the world's coming, but we're not quite there yet. And that's where we are with AI. I could see it's getting better, especially the specific AIs or the content specific AIs like coding. There's another one that's coming out that's called Tax GPT, where it's just going to be like an expert on taxes. You feed in all your financial information and it'll tell you how to optimize your taxes.
That one better be good, Jim. That one better be really good.
But keep in mind, we don't pay our accountant to do we do pay our accountant to do all that, but we also pay our accountant to shoulder some of the responsibility if it's done wrong. How will that work in Chat GPT? Right. You know what I mean? There are some questions that are unanswered that he becomes like our guy in the court proceedings.
Jimmy, remember when all the trading went electronic, all of a sudden the exchange was no longer responsible for any errors.
Right.
It's the same thing.
Yeah,
right.
So we were in the pit. The exchange would, they would moderate arguments, and they had an involvement in errors in the pit. And then they said, "This is now electronic. It's all on you. We take no responsibility if the system goes down. It's your problem."
Right.
And I suspect ChatGPT or AI taxes would be the same thing.
Right. And you see this with driverless cars too. What's the biggest problem they have with driverless cars? Is that driverless cars follow the rules. They follow every single rule all the time. What do human drivers do? Not follow the rules. That's why it's so difficult for driverless cars. They're always doing it right.
So when there's a rule that hasn't been written yet,
Yeah,
The
they have to
AI
interact
can't
in a
come up
world
with.
with human drivers is their problem. You know.
So
Okay,
here's
let's
what I
talk
want to
about-
go back to the Fed.
Oh, by the
with.
way,
You go back
if
to
we
the
have
Fed, 'cause I
time,
wanna talk
if we
about the
have
long end,
time,
too. Go.
if we have, let's go back to the Fed. But if we have time at the end, I want to talk about that shutdown or that with the CME the day after Thanksgiving. And the stories about
No,
that.
Bobby and I are both like, no. I don't think so. But anyway, Bobby, go on.
No, we're fine. So this is the Fed's balance sheet going back just past 2004, right? It's from the Fed website. You guys have obviously seen this a million times. And one of the things I didn't realize is that we're still well above not just pre-pandemic levels in the Fed's balance sheet, but pandemic levels, which would be right about, to the end of this little gray bar. I don't think you guys can see where I'm pointing to, and I can't really draw.
About $7
in
trillion
somewhere.
was pandemic levels. Yes.
Yeah. So you look somewhere around $4 trillion. When they go back to quantitative easing as they did, it's obviously much smaller than during the pandemic era. Do they just have to go flat again? Because obviously the balance sheet has been increasing since well into the 70s, right? Just minute amounts, and the balance sheet wasn't very big. Do they actually have to go back to levels, or can you see it to earlier levels, or can you see a reason outside of just manipulating the economy and causing inflation why they might say, well, this is actually the correct level given where we are now?
Well, what they used to do, I mean, not to get too technical about it, is they operate under what's called an ample reserve system right now. They used to operate under a corridor system. That's why you might remember that total excess reserves in the banking system pre-Lehman Brothers, and then this chart would be pre-2008, used to run like $2 or $3 billion, the whole banking system. Now it runs a couple of $1 trillion of excess reserves. And that's because they do this thing called this ample reserve system. They're operating under a completely different type of monetary regime. And so they're going to continue under this regime. And if they continue under this ample reserve regime, what you're going to see is that blue line is going to flatten out, and then it's going to start to slowly go back up. And again, I'll come back to what I said earlier. I want to not get into the weeds of the technicals of the Fed, but what is all of this about? All of this is about financing a $38 trillion government program, debt, and allowing $2 trillion of government deficits every year. And then the Federal Reserve Chairman gives speeches and goes, that's bad, but he continues to allow it to happen. And then we wind up with inflation. We wind up with distortions. We wind up with over-reliance on the government in the private sector because it's so big. And this is it. It would, like I said before, we'd be better off saying, you know what, guys, we're kind of at the limit here. You guys got to stop spending money in Washington. You just can't do it anymore.
Do you think there's hope for 2026? Because I thought 2025 was going to be bad for deficits. My base case was QE restarted. But my hope, and by the way, this is a narrow hope. My hope was that if there really is investment coming in, if there really is deregulation that's going to be broad, that perhaps we get an economy in 2026 that blows up revenues and deficits decrease. We've already started to see deficits decrease in a small way. Is there hope?
I hope there is, but I'm kind of pessimistic about it. The deficit has come down a lot because of the amount of money that they've collected in tariffs. But what is Trump planning on doing with that money that he's collected in tariffs in 26? He's planning on giving a $2,000 tax rebate.
I see. I don't believe that. I don't believe he is just because he says it.
I hope you're right, because that will just produce inflation.
So for people who are listening and trying to know what I'm talking about is, I think the $2,000 just because the SCOTUS is going to hand down their decision relatively soon. I thought he wanted to depict it as the benefit of the American people versus the Supreme Court. I don't think he's that stupid to send out checks of $2,000. But I didn't mean to cut you off, Bianco. You go.
But I know you're right. I hope he doesn't. It's not that I don't want these people to get this money, but we learned this in 2020. If I give you $2,000, what are you going to buy with it? The answer is nothing. It's just going to be $2,000 more expensive. You're just going to buy the same things you can buy now. You're just going to pay more money for it. It's not going to allow you to buy extra things.
And the asset holders are the ones who win. Bobby, you go. Yeah.
I want to read a comment from Widge in here. Widge is a big viewer of the show, Jim, and he's a fan of yours. He said, I just wanted to thank Mr. Bianco for being a voice of reason and giving us the accurate play-by-play about the Fed. real economy and policy impacts over these last couple of years too rare. So I just wanted to read that for you.
Thank
So
you.
Jim, what did
I
you?
appreciate it.
Yeah, what did you say you wanted to cover? I missed when you said that because your sound went out of my ear here.
Oh, I wanted to cover potentially two other things here real quick. Oh, there's my cat. Here's my cat.
Oh, look at that guy. Yeah.
I wanted to cover two other things real quick. One, I wanted to make a quick comment about population growth and then maybe the CME, but we
Yeah.
can save that for the very end.
I'll just do this while you do the CME.
Okay, I could, yeah. The population growth thing is something else that's interesting. I want to go back to what Powell said last week.
Okay.
He said that we're overstating jobs by 60,000 a month. And that if you factor in that overstatement of jobs by 60,000 a month, that payrolls over the last 6 months might have been minus 20,000. Okay, question. If payrolls really are minus 20,000 a month, why did the stock market make an all-time high last week? Why are 10-year yields still above 4% when they were at 360 when the Fed started cutting rates in September of 24? Why aren't they plummeting down? Why? Because every time we have a string of negative payroll numbers, every other time, it's been a recession. So why is the stock market and the bond market not acting like we're having a recession? And the answer is maybe minus 20,000 jobs is not that far away from the number that we need. And the reason I say that is because the biggest driver of job growth in the United States is population growth. And Trump 2 weeks ago said we have zero immigration into the illegal immigration in the country in the last 6 months. Last week, the Department of Homeland Security put out a press release saying 2.5 million people have been deported this year. 2 million self-deports, 500,000 arrests. If you add those numbers in and you say, man, that means that we're net minus 2.5 million from immigration, where in 2023, we were plus 3 million from immigration. That's a 5 million swing. Then actually, if you do the math, you could make the case that the break-even rate on the number of jobs that the United States economy needs to create, because it's got no population growth, is 0 to slightly negative. So why is it that the market seems to be not freaking out about minus 20,000 payroll jobs, as the chairman said last week? Because it's not that far away from what we need. It might only be 10 or 20,000 jobs away. Gone are the days of 100 to 150,000 jobs. We maybe just need anything above 0 is all we need. And that's enough jobs because we have no population growth.
But you're saying that it's a stagnant economy going forward then? Or can we get
a stagnant population growth economy. The only job growth you'll get is from productivity. That's it. Now, there'll be some possible from productivity, but it's also possible that population growth could be negative this year. And in the 250 years this country's been around, we've only had one negative year, one in 249 years. And that was 1918, the Spanish flu. And 2025 might be the second year that we do that. And so, yes, you got to keep in mind, economic growth starts with what's your population growth? And a lot of emerging markets usually have very high fertility rates, and they usually have exploding population growth. And that's why they have exploding growth. If we have no population growth, and we're not getting it from fertility because our fertility rates are below replacement, we were getting it from immigration and we stopped that, then we don't. By the way, what the markets are telling you is that's not bad. It's just different. We're just used to it being these positive numbers because of population growth. Well, that's why the stock market's at an all-time high. That's why yields aren't falling, because we don't need that many jobs, because we don't have that many new entrants into the workforce every year.
So Jim, we had Kamal Shri Kumar on last week. Are you familiar with him?
A little bit, yes.
Yeah, Shri's main take was that we're already in a mild stagflation and it's about to get worse in 2026. He also said he believes the Fed is necessary, but does not believe the FOMC is necessary. Can you comment on both of those things?
I can understand the stagflation story because, I still think that we're in a 3-ish% inflation world, if not more, and that is going to be a problem. And the reason that is going to be a problem, you might say 3%, why is it? It's not that much different from 2%. Everybody's screaming about affordability. And I'll give you a statistic. Since the end of COVID, The CPI index is up 27% total since the end of COVID. Everything is 27% more expensive. People are complaining about the price level being so high. Everything is so expensive. How do you fix that? Well, you don't want outright deflation, just make prices go down. That would be bad for the economy. The best way to fix it is you want to have very low inflation growth for a couple of years so that wages and everything else can catch up to that price level.
Sure.
But 3% is not going to do it. You need like 1% inflation, maybe 0.5% inflation. 3% is just going to keep everybody spitting mad that everything's so expensive. So you're not doing anything to fix that problem right now. So the stagflation problem with high inflation, I think, is a problem. Could the economy slow next year? Sure, but I don't think it's a recession. As far as the FOMC goes, I'm not familiar with his argument about the FOMC. I understand why you need the Fed. The Fed has other functions. The Fed is a banking regulator. They clear checks. You need somebody to do those functions. I understand that. The FOMC to set monetary policy, to set interest rates. Milton Friedman argued this 50 years ago to get rid of the FOMC. That the problem is, I'll interject with Jim Grantism, right? He calls it the PhD standard, where all these PhDs sit around and guess as to what the right interest rate is supposed to be. And they usually guess wrong more times than they guess right. And that maybe something like a gold standard or a Taylor rule or something like that. Is it perfect? No, it's not perfect, but it's better than the PhD standard. So that might be an improvement to it.
You mentioned the long end before. You mentioned the 10-year. And by the way, the not QE, the furthest thing from QE that they launched last week, is strictly concentrating on the short end, which I assume means that they want the Treasury to continue selling their bonds on the short end and not to be stepping a foot on the neck of the long end. Do you view it that way? And where do you view long end rates going? 10-year, I guess I'm saying.
Well, let me. Yes, they're issuing more and more short end securities. Like they're issuing more bills and not as many bonds. Trump said this last week. He suggested that they should issue more bills, and then the Fed will cut the funds rate to 1%, and it will lower the interest cost of the United States. Now, there's a giant problem with that argument, and first of all, that argument's known as fiscal dominance. That basically what fiscal dominance means is that monetary policy cannot be set, by itself. It needs to consider what Congress is doing. That's the fiscal dominance part. But here's the problem with fiscal dominance. Let's say Trump's right. Let's issue all bills. Fed drops the funds rate to 1%. Bills rates go down to 1%. We pay less on interest costs. Okay? When can we stop doing that? And the answer is never. We can never stop. We have to keep rates at 0 to 1% forever. What will happen somewhere down the line? We'll get inflation.
Clearly.
What will the bond market do when we have inflation, the Fed says, I can't raise rates ever because of fiscal dominance? Blow up. Yeah. Yields go to the moon. So basically, fiscal dominance, the metaphor I'd used with it is, if we went down that route, is we pulled the pin on a hand grenade, we're all going to argue when it's going to blow up and kill us. But It will blow up and kill us. That's now it might be 10 years, it might be in 3 months, but so you don't want to go down that road.
So is the steepener still the trade?
Yes, because if inflation is the issue, the long end of the yield curve keeps going up, yields keep going higher, but the Fed, because they're not ready to, raise rates, that stays down and the yield curve steepens and long rates keep going up.
Before I bounce the next, I was going to bounce the next question to Bobby, but for you guys watching, the historic rate of 2s to 10s is about 104. If I'm saying anything wrong,
no, it's about 100 basis points, right?
Right.
Yeah,
about 100 basis points. And right now we're 55-ish. Is that where we are right now?
Yes.
Yeah. Okay. So, but anyway, I might put that trade. Yeah.
I'll put those numbers just in numbers for you. If the long run inflation rate is now 3, not 2, and we're 6 years past COVID and we still can't get below 3% on inflation. So that would be my argument. Maybe it is 3. That means if it's 3, and the Fed likes to use this thing called R star. What does that mean? What is the neutral rate above the long run inflation rate? If that's 1%, like the Fed says, that means the neutral funds rate is 4. We're 3.5. We're below that. That means if the neutral funds rate's 4, getting to your yield curve argument, that means about a 4 340-ish or so on the 2-year note, because it usually trades around 40 basis points above the funds rate, and around a 5.5 to 5.25 10-year note. We're at 415 on the 10-year note right now. So we're really low on rates. That's why I think rates will continue to go up and the yield curve will continue to steepen.
Yodio, this is my last question, just so you know. But
Sure.
Jim, you've been on the show a bunch of times, and I don't think I know your stance on Bitcoin, but I have a specific question. One of the things that Jim Iorio brings up all the time, I think is a very smart way to look at it, is for people who say Bitcoin has no value, neither really does the Honus Wagner baseball card, right?
Right.
But it's worth millions and millions of dollars. And I was thinking about that. There's a specific reason, because Natalie Brunell, who's the
I know
host
Natalie.
of Coin Stories,
Sure.
yeah, she wrote this book. And I'm interviewing her in January, so I'm reading the book. And the scarcity thing is one of the things I keep telling Bitcoin people. They have two specific problems, if you ask me. The Bitcoin maximalists, right? Number one, you say it can't go to zero. And to me, there's nothing on the planet that can't go to zero. As a matter of fact, the minute I hear that, I want to get out of that particular asset. And the second thing is, unless you get adoption, because everybody who's in Bitcoin, they say they're not in it for the appreciation. They say they're in it for the security of it. But then it's not an asset. I mean, it can't be used for anything if you're just holding it to protect your wealth, and it goes down against the US dollar, you're not protecting your wealth. It's not an investment. It doesn't generate anything. It's similar to gold. It's a safety asset, right? Gold has generated returns, but that's not really the point of gold for the gold bugs, of which Jim and I are not. Jim and I bought gold to make money on it, not to store assets. So number one, are either of those two things crazy? And number two, I don't think I know your stance on Bitcoin.
I got into the crypto space 2016, 2017, or became aware of it and started dabbling with it back then. And I got really long-term bullish on it and long-term excited on it, and I still am. But occasionally I get frustrated with the space. And I think I'm in one of those frustrations with the space right now. And that's why, and I think a lot of other people are, and that's why the price is struggling. So let me explain. I got interested in it because I saw it as a disruptive asset. Not only Bitcoin, but Ethereum. And I know that maximalists are going to lose their mind because I brought up ETH. Not only Ethereum as not only a new currency that actually has a pegged inflation rate with the halving and everything else that can't be manipulated by a central bank, but with decentralized finance, a new financial system altogether. Who needs this system? You and I and everybody listening to this podcast, we don't need it. We're the apex predators. We're in the United States. We've got a system with rule of law and with defined rules and with stable regulations. But the majority of the world lives in places with unstable currencies and corrupt financial systems, that if their currency is not devalued away to nothing, their money in the bank is stolen from them because they can't trust anything. They need something like decentralized finance, something that is permissionless, something that is decentralized, that can't be taken away from you. They need something like Bitcoin, where the store of value is ironclad and that it cannot be manipulated by a government or a central bank. I've been all in. If that's what the crypto crowd wants, I am all in, and they say that that's what they want. But occasionally they lose their way. And they lose their way by kind of getting all bent out of shape about speculation. And the latest level of speculation was, here come the boomers with adoption, with the ETF and everything else. I'm like, you're now losing the sight of that you want to create an alternate financial system. And not only do you want the boomers to come in, but you're passing the Genius Act. You want to pass the Clarity Act. You want to sidle up to the president. You want to become part of this system that you are trying to disrupt. When Travis Kalanick first started Uber, he was asked why he didn't sell it early on to Yellow or to Taxi, because he said, because I didn't want their money. I wanted their whole entire business. I wanted to disrupt them off the world. The same thing with Netflix. Netflix could have sold to Blockbuster, but they wanted to just redefine the whole business. by Bitcoin and everybody else saying, no, we're going to pass all these laws and we're going to be nice to the president and he's going to allow us to do this and we're going to get the boomers in, you're missing the point. You've lost the idea that what you're driven by is to create an alternative. And the last thing I'll say to the maxis, my Bitcoin maximalist friends that always think that ETH is shit and Bitcoin is the way to go, your enemy is not Ethereum. Your enemy is JP Morgan and the Federal Reserve. And quit sucking up to them and start thinking about some of the other cryptos that could help you, because DeFi is really something that's come out of Ethereum. And start creating a new financial system. Who's it for? It's not for us listening to this conference, to this podcast. It's for 3 billion people in the world that could use it, and eventually will be forced to adopt it because it will become the standard of the rest of the world. That's where I think Bitcoin is. That's where I think crypto is. But right now, they've lost their way. They're all short-termism. We just want all the boomers to buy the ETFs so that number go up and we can then, become very rich. And that's when it winds up having trouble, because they've lost their focus, and they've lost their focus right now. So long-term, I'm bullish. I just think that's the problem right now.
So you guys, you give just mind-blowing different takes on things that I absolutely love. But more importantly, did you go to our furthest western suburb of Chicago for the winter and not Florida because of the mountain biking? Is that why?
Yes, I do have my bike here, and I'm planning on getting out there this afternoon.
That's
so
awesome.
I'm hoping to do that.
Yeah, I love it. By the way, when wherever you are in that furthest western suburb, is half the people from Chicago?
Yeah, pretty much. I mean, Scottsdale and Phoenix has a very Chicago feel. There's all the stores and all of the restaurants and stuff. If there's one in Chicago, there's one here.
Sure.
Yeah, it's the same thing down here. We don't have that particularly yet. There's a Portillo's about 2 hours away, but there's a bar down here called Sonny's, and it's a Bears bar. And every time the Bears score,
are you on the West Coast or the East Coast?
I'm on the West Coast.
Okay, so that's more Midwesty. The East Coast
Midwest.
is like
that particular bar, every time the Bears score,
except for Jewish people, they from both New York and Chicago, they go to Palm Beach. So Chicagoans go to the Gulf Coast, New Yorkers go to there, but the Jewish people all go to comes from all my friends to what's the place just south of Miami? Key Biscayne or Palm Beach. Yeah. So
where I'm at is Midwest, and like I said, this bar Sonny's, when the Bears score a touchdown or something, there's a couple that runs around with a big giant Bears banner and they play the theme song and the whole place goes nuts. It's actually really fun.
All right, let's wrap it up. Let's play us out. Thank you guys so much. I love doing the shows. I love the live element. You guys are the best. And Nicole, you're not our fans. We're fans of you as much as you are us. Guys like Widge and Sterling and Remo. You guys are smart guys, and I appreciate you being in our corner. Thank you to our sponsors, Independence Arc Farms in Arkansas. Go on their website. Try some of their grass-fed, grass-finished beef. You will not be sorry. Also, own physical gold and silver. The American Gold Exchange. The link is on our page. Talk to Dana Samuelson there. He will set you up. And finally, unfilteredinvestor.com. Bobby, what you and Mike do is just amazing. Thank you, guys. This has been The Future's Edge. I'm Jim Muro. That's Bob Icino. And, of course, that's Jim Bianco. I'm not going to even tell you where to find him because everybody knows where to find Jim Bianco. Just go on Twitter.
Okay, Scottsdale.
Scottsdale. Right. Thank you.
Thank you.